Imagine it is 1987. You're a 34-year-old factory worker in Flint, Michigan. You have just signed the papers on a brand new truck. You drive off the lot, feeling something you have been chasing your entire adult life. You feel like you finally own something. Your father never owned a new vehicle. Your grandfather worked 40 years and died with nothing. But you are building wealth. You have a house, a truck, a closet full of clothes, a garage full of tools, a life insurance policy your cousin sold you. Here is what no one tells you. Not the banker, not the salesman, not the financial literacy pamphlet at the Union Hall. Almost everything you think you own is not building wealth. It is consuming it. This is not opinion. It is accounting. An asset puts money into your pocket over time. A liability takes money out. That is the entire distinction. Does it generate income? Does it appreciate reliably? Does it reduce future costs? If the answer to all three is no, what you own is not an asset. It is a consumption item with a delayed bill. Once you see this, you cannot unsee it. Let us begin. Number 1. The vehicle. In 1950, the average American vehicle cost approximately $1,500, roughly 46% of median annual household income. By 2023, the average new car transaction price reached $48,000, roughly 63% of median household income. The core financial mechanics, however, have not changed in any meaningful way. The moment you drive a new vehicle off the lot, it loses between 9 and 11% of its value. Within 5 years, even a well-maintained vehicle retains only 40% of its original purchase price. Financing terms have stretched from 48 months in 1990 to 72 and 84 months today. Not because vehicles improved, because they became unaffordable at honest payment terms, and longer loans were the industry's answer to that gap. Add insurance, registration, fuel, maintenance, and repairs. The average American spends over $12,000 annually on vehicle ownership. According to ODA's 2023 cost study, over a 5-year ownership period, that figure exceeds $60,000 in total cash outflow. For an item that will sell for perhaps $15,000 at the end. That is not an asset. That is a $45,000 loss structured to feel like ownership. Who benefits? The automaker, the finance company, the insurance provider, and the fuel industry, the repair network. An entire ecosystem extracts wealth from you while you believe you're building equity. The vehicle is not an asset. It never was. Number 2. Whole life insurance. In 1945, whole life insurance represented the dominant share of the American life insurance market. Agents positioned themselves as financial advisors, trusted community figures, and genuine friends of the family. The pitch was simple and reassuring. Pay premiums throughout your working life. Build cash value. Pass on a death benefit. One product, multiple purposes, complete peace of mind. Here is what the pitch omitted. The average whole life policy returns between 1 and 3% annually on its cash value, below inflation in most decades. The same premium dollars in a basic index fund would have returned 7 to 10% historically. The difference compounded over 40 years is not a rounding error. It is the difference between financial independence and financial regret. A $200 monthly whole life premium over 40 years accumulates perhaps $150,000 in cash value. The same $200 in equities at historical averages grows to over $600,000. Where does the gap go? Commissions. The agent earns between 50 and 100% of first-year premiums the day you sign. Insurance overhead, marketing, shareholder profit. The cash value is not wealth you're independently building. It is a savings account inside someone else's profit engine, returning far less than you could earn on your own. The term life insurance provides identical death benefit coverage at 1/10 the cost for most healthy individuals. The difference invested independently builds significantly more wealth than whole life insurance ever could. Millions of working-class families were told they were building wealth. They were building someone else's. Number 3. The equipment. The American home has become a museum of abandoned productivity. Home gym setups averaging $3,000, professional kitchen appliances, photography equipment for a hobby that lasted 3 weekends, power tools bought for projects that never started. Each item was acquired with genuine intention to create, produce, or save money. each one felt like a responsible investment at the point of purchase. Studies show that after 6 months, 67% of home gym equipment is used less than once per week. After 2 years, the majority sits untouched for months at a stretch. The equipment did not fail. The behavioral model behind the purchase failed. When sold, the average recovery rate is approximately 20 cents on every original dollar spent. Retailers understand human aspiration better than consumers understand themselves. They sell the equipment required for the person you are currently planning to become. That gap between who you are and who you intend to be is the actual product being purchased. Number 4. Collectibles. In 1991, a mint-condition Wayne Gretzky rookie card sold for $100,000. An entire generation was taught that cardboard, properly stored, was a legitimate investment vehicle. By 1998, the market had collapsed. On cards purchased for hundreds sold for pennies. The same pattern has repeated in Beanie Babies, comic books, stamps, coins, and NFTs without exception. Collectibles appreciate only under 4 simultaneous conditions: genuine scarcity, sustained generational demand, third-party authentication, and immediate liquidity at the exact moment you need to sell. All 4 are entirely speculative. Not one is within your control at time of purchase. For every collectible that sells for millions, 10,000 collections are quietly disposed of at estate sales for nothing. That is survivorship bias, mistaken for strategy. Number 5. The primary residence. This is the item that generates the most anger. The mathematics do not respond to emotion, and they do not make exceptions. For most American families, the primary residence is not the asset they have always been told it is. When you purchase a $300,000 home with 10% down and a 30-year mortgage at 7% interest, you pay approximately $418,000 in interest alone over the full life of the loan. Add 30 years of property taxes at $4,500 annually, $135,000 total. Add 30 years of homeowner's insurance, $45,000. Add maintenance at 1% of home value annually, $90,000 conservatively. The total cost of ownership approaches $690,000 on a $300,000 purchase. For that home to function as a genuine asset, it must sell for more than $690,000 30 years from now. That requires consistent annual appreciation above 4% every year without interruption. Possible in select markets, not guaranteed across most of the country. The $30,000 down payment invested instead in a simple index fund at 8% annually over 30 years grows to approximately $300,000 on its own, without a mortgage, without property taxes, without a maintenance emergency. After the 2008 financial crisis, 12.5 million American homeowners found themselves underwater, owing more than their homes were worth. These were not reckless buyers. They followed every conventional instruction given to them. They purchased. They paid faithfully. They believed the promise. The asset disappeared anyway. Not one of them was taught to run these numbers before signing the closing documents. They were taught that renting is throwing money away and ownership is always the responsible path forward. The housing industry, mortgage industry, insurance industry, and real estate brokerage all collect fees regardless of whether the homeowner builds equity or loses it. Every risk transfers to the buyer. Every fee stays with the system. For millions of American families, the house was not a foundation. It was the most expensive liability they ever agreed to call an asset. Number 6. The college degree. In 1980, the average annual tuition at a 4-year public university was $2,100 in inflation-adjusted terms. By 2023, that figure exceeded $10,000 before room, board, and mandatory fees pushed the true annual cost towards $25,000. The earnings premium for college graduates grew from roughly 40% above high school graduates to approximately 80% today. The conventional narrative appeared to be fully validated by those numbers, but aggregate statistics always conceal their distribution. The earnings premium is driven almost entirely by graduates entering engineering, computer science, medicine, and law. For graduates in humanities, education, social sciences, and the arts, fields representing the majority of undergraduate enrollment, The earnings premium frequently fails to exceed the total cost of attendance when measured across the first decade after graduation. Student loan debt in the United States now totals over $1.7 trillion. The average borrower carries $37,000. 1 in 4 borrowers has watched their outstanding balance increase over time because monthly payments do not cover accumulating interest. A student borrowing $45,000 for a degree with a median starting salary of $38,000 enters a repayment structure that mathematics cannot close at standard terms. Interest compounds faster than principal shrinks. After 20 years, the forgiven balance becomes taxable income, generating a liability the borrower typically cannot pay. The universities understood this math before the loans were signed. The lending industry understood this before the loans were signed. The student is not the customer. The student is the mechanism through which federally backed loan dollars transfer from the public treasury to university endowments. Number 7. The wardrobe. The average American household spends $1,700 annually on clothing. Over a 40-year working life that totals $68,000 in nominal spending. Studies on actual clothing utilization show most people wear roughly 20% of their wardrobe with any regularity. The remaining 80% hangs, depreciates, and eventually reaches a donation bin. The fashion industry calls this building a wardrobe. Accounting calls it consumption with a storage problem. Number 8. Extended warranties. In 2022, extended warranties generated over $40 billion in United States revenue. Providers pay out approximately 20 cents for every dollar collected in premiums. The remaining 80 cents is administration, marketing, and profit margin built into every product sold at every checkout counter. For every $100 spent on extended warranties across a consumer lifetime, the expected return in actual repair or replacement value is approximately $20. That is a psychological product sold at a financial price. Number 9. The timeshare. In 1974, the American timeshare industry generated approximately $50 million annually. By 2019, that figure exceeded $10 billion. Timeshares are sold as real estate ownership, a piece of paradise, an asset you can use, rent, trade, and pass to your children as a lasting legacy. The reality lives inside the maintenance fee structure the sales presentation never adequately emphasizes to prospective buyers. Average annual timeshare maintenance fees now exceed $1,000 and rise every year at rates outpacing inflation, often 4 to 8% annually. They cannot legally be refused without forfeiting ownership entirely. They follow you to death and transfer as a legal obligation to your heirs, who will spend years and money attempting to escape them. A timeshare purchased for $20,000 with a $1,000 annual fee costs $40,000 across 20 years. Resale value is effectively zero. Thousands list on secondary markets for $1 and receive no buyers. Entire law firms exist to help families exit timeshare contracts. Exit fees sometimes exceed the original purchase price itself. Number 10. Jewelry. The average retail markup on jewelry ranges from 100 to 300% above wholesale cost. A ring purchased for $3,000 at retail contains approximately $800 of actual material. The remaining $2,200 is markup, manufacturing cost, brand premium, and margin, none recoverable on resale. Pawn shops and diamond buyers offer 20 to 30% of retail value. The Diamonds Are Forever campaign, launched in 1947, was not consumer education. It was a strategy designed to eliminate the secondary resale market and maintain artificial scarcity at retail pricing levels. Number 11. Cash itself. This is the most counterintuitive item on this list. Cash does not feel like a liability, as it is universally accepted. It is the benchmark against which every other asset is measured. But cash has one feature most people do not viscerally understand until damage has already accumulated. It loses real purchasing power every single day. At 3% annual inflation, the long-run historical average, cash loses half its purchasing power in 24 years. The balance on the statement never changes. The purchasing value evaporates regardless. People who can least afford this loss are most likely to hold cash because they have watched enough predatory products extract from their families to distrust every alternative. That distrust is often earned. But holding cash in response guarantees slow and permanent wealth destruction. Inflation is not accidental. It is explicit central bank policy. The system rewards people holding appreciating assets and steadily punishes people holding cash. That is not a design flaw. That is the design. 12 items. Everyone marketed aggressively to working-class families as wealth-building behavior. Everyone generates no income, depreciates over time, requires ongoing costs, and proves difficult to liquidate at fair value. Everyone benefits the seller significantly more than the buyer. And everyone serves a psychological function, making you feel like you are accumulating when the accounting clearly shows you are depleting. The factory worker in Flint did not fail. The system worked exactly as designed. It extracted a lifetime of labor and left behind a vehicle that depreciated, a policy that underperformed, a house that barely sells above what was paid into it, and no liquid wealth to pass forward. His children inherited the same vocabulary, the same steps, the same purchases framed as progress. They were told the same stories by different salespeople operating inside the same structure. The pattern continues because the financial education system never taught the difference between an asset and a liability in terms clear enough to act on before the first signature. An asset puts money into your pocket. A liability takes it out. That distinction, learned early enough, changes every decision that follows. The things you think you own may be the very things that own you. This is the economic records. Your grandfather worked 40 years inside this system without ever seeing it. Your father made every payment it required and called it progress. The vocabulary was handed to you before you were old enough to question it. The car, the policy, the house, the degree, the warranty, the ring. Every item on this list was waiting for you before you were born. The system does not need your ignorance to function. It only needs your participation. We exist to end the participation that comes from not knowing. The ledger always balances. It has balanced in the same direction for 3 generations. This channel exists to make sure it does not balance that way for a 4th.